how does a multi-billion-dollar restaurant empire use the plunging price of bulk butter to subsidize the skyrocketing cost of your Friday night steak?
Yeah, that is definitely not something you think about when you're just, sitting down for a nice meal.
No, not at all. I mean, today we are stepping entirely out of that romantic, chaotic kitchen environment that we usually associate with hospitality.
Right, the whole chef-driven fantasy.
Exactly. And instead, we're walking straight into the cold, hard mathematics of modern corporate survival. So welcome to today's deep dive.
Glad to be here.
We have a really fascinating stack of corporate disclosures in front of us today. We are looking directly at the Q3 2026 earnings presentation, along with the financial data from Darden Restaurants.
Dated March 19th, 2026, just for context.
Right. And for anyone who, might not recognize the parent company name right away, you absolutely know their dining rooms. I mean, they are the engine behind some of the most ubiquitous full-service restaurants in the world.
Well, without a doubt. And we aren't just looking at these numbers to give you a boring stock report.
No, definitely not.
We're really looking under the hood here to see how an absolute titan of the industry is navigating things like inflation, labor shortages, and, well, shifting consumer habits right now in 2026.
Which is exactly why you should care about this, even if you have never read a financial statement in your life. Because whether you're like an everyday investor looking for yield or an entrepreneur trying to scale a business or
just someone who occasionally likes to go out and order a bowl of pasta.
Yeah, exactly. Just a regular diner.
Yep.
Understanding how a giant company balances the rising cost of beef with keeping you happy, it's incredibly revealing. It is essentially a real-time stress test of the broader economy. So, okay, let's unpack this.
Yeah, let's do it. So to really grasp the sheer complexity of what Darden is pulling off, we have to start with the architectural blueprint of their empire.
Right, because we aren't talking about a regional chain of diners here.
No, not at all. We are talking about 9 distinct brands operating under one massive corporate umbrella.
And the variety is wild, too. I mean, you've got Olive Garden, LongHorn Steakhouse, and Cheddar's Scratch Kitchen, and they are basically handling the massive casual dining crowds.
Right, high volume. And then you've got Yard House, Seasons 52, and the newly acquired Chuy sitting in that polished casual space.
Yeah. And then at the very top, you have the Capitol Grill, Eddie V's, and Ruth's Chris, catering to ultra-premium fine dining.
Where a single table might drop, a mortgage payment on prime seafood and 8 steaks.
Seriously. And managing just one of those demographic segments is notoriously difficult. I mean, the restaurant business is famously failure-prone.
It's brutal. But Darden's driving philosophy for managing all 9 of these drastically different concepts is something they call brilliant with the basics.
Brilliant with the basics.
Yeah. They define this as aiming for financial success through great people, and consistently delivering outstanding food, drinks, and service in an inviting atmosphere.
Which, I mean, on the surface, brilliant with the basics sounds like a motivational poster you'd see in a break room.
It really does.
But the reality of standardizing that across thousands of locations is basically a logistical miracle. It's like conducting an orchestra playing 9 entirely different genres of music at the exact same time.
Oh, that's a good way to put it.
Right, because you've got the string section playing classical at the Capitol Grill, you've got the brass section playing country over at LongHorn, and the percussion doing something totally different at Chuy.
Yeah.
But Darden's real trick is that they've centralized the sheet music, the instrument repairs, and the ticket sales into one single back office.
Oh.
So somehow it all sounds harmonious to the shareholders.
And if we connect this to the bigger picture, that harmony for the shareholders is incredibly specific. Darden operates on what they call a long-term framework.
Okay.
And it's designed to guarantee a total shareholder return, or TSR, of 10 to 15% over time.
Wait, let's pause there for a second. Because throwing around a guaranteed 10 to 15% return in an industry with, razor-thin margins, that sounds incredibly bold.
It is very bold.
How exactly are they engineering that math?
Well, it's a combination of 2 main levers. You've got earnings per share growth and then a really heavy dividend yield.
Okay, break that down for me.
Sure. So they target 1.5 to 3.5% growth in their same restaurant sales.
Mm-hmm.
And then they add another 3 to 4% growth just by building brand new restaurants.
Makes sense.
But the kicker is their dividend payout ratio. They actually aim to pay out 50 to 60% of their earnings directly back to shareholders in cash.
Oh, wow.
Yeah, while also aggressively buying back their own stock at the same time.
Which is fascinating when you think about it mechanically. Because by constantly buying back their own shares, they reduce the total number of shares that even exist. So even if the company's overall profit stays totally flat, the earnings per share still go up, because that same amount of profit is just being divided among fewer slices of the pie.
Precisely. It's basically a financial buffer against a slow quarter.
Right.
And they explicitly list their competitive advantages to pull this off in the presentation. It isn't just, we have the best recipes.
No, of course not.
They cite significant scale, extensive data and insights, and rigorous strategic planning.
See, I really want to dig into that extensive data piece, because how does an Olive Garden actually use data to hit a 15% shareholder return?
Think about the biggest variable in a restaurant. It's labor.
Right, staffing.
Exactly.
Yeah.
If you overstaff on a slow Tuesday, your profit for the week is just gone.
Yeah.
But if you understaff on a busy Friday, the service collapses, the guests get angry, and they don't come back.
Yeah.
So Darden uses immense historical data, weather patterns, and even local event schedules to predict foot traffic down to the 15-minute increment.
Wait, 15-minute increments?
Yes. They know exactly when to cut a server or fire up an extra grill.
That is wild. That is so granular. But to their credit, alongside all that algorithmic tracking, they do also highlight the human element.
They do, yeah.
The presentation literally states that their greatest edge is the quality of our employees reflected each day in the job they do.
Well, they have to recognize that. I mean, you can have the most sophisticated predictive staffing model on Earth, but if the frontline server drops the soup or is rude to a guest,
the data cannot save the experience.
Exactly. In hospitality, your employee is your ultimate product delivery mechanism. No data can fix bad service.
Absolutely. So we have this blueprint. We've got a multi-brand orchestra, a strict 10 to 15% return framework engineered through buybacks, all powered by massive data.
Right.
Let's look at the Q3 2026 scorecard. Did the orchestra actually play in tune this quarter?
They really did. For a 3-month period, the volume of money moving through this company is just staggering. Total Q3 sales hit $3.3 billion.
$3.3 billion in one quarter.
Yeah. That is a 5.9% growth over the exact same quarter last year.
And their same restaurant sale. So basically stripping out the new locations just to see if their core existing stores are actually growing, that came in at a solid 4.2%.
Which is very healthy. Furthermore, their adjusted EBITDA came in at $579 million for the quarter.
Wow.
And true to their framework, they returned $300 million in cash directly to shareholders through those dividends and stock repurchases we were just talking about.
Okay, let's quickly translate adjusted EBITDA for anyone not staring at a Bloomberg terminal right now.
Good idea.
It basically just means their profit from actual day-to-day operations. So the cash generated before the tax man, the banks, and the accountants take their various cuts.
Right, it's the pure operational cash flow.
And $579 million operational cash flow is huge. But wait, I need to challenge this a bit.
Okay, let's hear it.
Because I am looking at the brand breakdowns and the source material, and there is a massive leak in the bucket here.
I know exactly what you're looking at.
Right, because total sales are up nearly 6%, and same restaurant sales grew 4.2%. So they're driving higher volume. The restaurants are objectively packed.
Yes, they are.
But when I look at the profit margins for the individual brands, well, Olive Garden pulled in $1.39 billion, but their margin actually dipped slightly from 23.1% down to 23.0%. LongHorn pulled in $854 million, but their margin dropped noticeably from 19.7% down to 18.6%.
Yep.
And even fine dining sits at a 22.0% margin, which is down from 22.5% last year.
It's a consistent trend across the board.
So how are they bringing in significantly more cash at the register, but somehow keeping a smaller percentage of it as profit? Are their menu prices just failing to keep up with inflation?
That contradiction right there is the defining reality of the restaurant industry in 2026. What you are observing is the intense squeeze between top-line revenue and bottom-line profitability.
So basically, the cost of the ingredients and the fryers is just rising exponentially faster than they can raise the price of a steak.
Exactly. Yes. And it shows that achieving that long-term shareholder return is becoming heavily dependent on sheer scale.
Oh, I see.
They have to open more restaurants and generate massive overall volume because the comfortable profit margins at individual locations are slowly eroding.
Wow.
Even with customers spending more money, the underlying cost to serve that customer is just chipping away at the foundation.
Okay, to really understand that squeeze, we have to look directly at the company's grocery bill and their payroll. Like, what are they actually spending all this money on?
The presentation breaks this down beautifully.
Yeah.
Let's start with the human cost. Restaurant labor actually became unfavorable by 20 basis points compared to Q3 2025.
Okay, meaning labor costs ticked up. And just for the listener, a basis point is just 1/100%.
Right.
So 20 basis points is 0.2%, which, sounds tiny, but on $3.3 billion, that is a massive hit to the bottom line.
It's millions of dollars. Exactly right. Labor is now eating up 31.3% of their total sales.
Jeez.
So roughly a third of every dollar you spend on your meal goes straight to the staff and management. And that cost is steadily creeping upward.
Now, contrast that with the physical food, because you might expect ingredient costs to be totally out of control right now. But food and beverage makes up 30.7% of sales, which is actually favorable by 50 basis points.
Yeah, it's surprising at first glance.
Their food costs slightly improved as a percentage of sales. How does that make sense?
Well, as an aggregate, yes, they improved. But looking at the aggregate grocery bill is super misleading. You really have to peel back the layers of that 30.7% because the commodity market right now is wildly fractured.
And here's where it gets really interesting. They provide a line item breakdown of what they're actually buying.
Right.
Beef makes up a massive 25% of their total food spend. A quarter of everything they buy is beef. And it is facing what they call high single-digit inflation.
It's expensive right now.
Extremely. Then seafood is 9% of their spend, and that is getting absolutely hammered with low double-digit inflation.
Also true.
But then you look at dairy and oil, that is 13% of their spend, and it is experiencing high single-digit deflation. It is actively getting cheaper.
What's fascinating here is how these completely disparate economic forces just collide within a single company supply chain.
Yeah.
And how it heavily impacts the different brands you mentioned earlier.
It's basically an economic seesaw in the kitchen.
Yeah, exactly.
On one end, your mozzarella cheese, your butter, and your frying oil are plunging in price. But on the other end, the ribeye steaks at LongHorn and the fresh shrimp at Eddie V's are absolutely burning a hole in the corporate wallet. And meanwhile, the cost of the chefs cooking it is slowly ticking up across the board.
Let's apply that seesaw directly to the margin leak you noticed a minute ago.
Okay.
You pointed out that LongHorn's margin dropped by 1.1%, while Olive Garden's margin only dropped by a tiny 0.1%.
Right.
Think about what those two restaurants actually sell.
Oh, I see where you're going. LongHorn is selling huge slabs of beef, which makes up a quarter of Darden's entire food spend and is suffering high inflation.
Exactly. They are eating the brunt of that cost spike.
But Olive Garden is essentially just a pasta and cheese delivery vehicle.
Precisely. Olive Garden's menu is heavily weighted toward dairy and wheat. Dairy and oil are seeing high single-digit deflation, and the presentation notes wheat is only seeing low single-digit inflation.
Wow.
So Olive Garden's underlying ingredient costs are actively dropping, which stabilizes the overall parent company.
That is corporate synergy at its absolute finest. They are literally using the cost savings on bulk Alfredo sauce and breadsticks to subsidize the brutal inflation on prime rib and lobster.
It really is brilliant.
If Darden only owned steakhouses right now, their margins would be in free fall. But because they have a diversified portfolio of menus, they can absorb the shock.
It proves how vulnerable even mega corporations are to raw material markets. But it also shows the defensive brilliance of owning 9 different concepts. They are structurally hedged against a crisis in any single commodity.
That makes total sense. So what does this all mean for the horizon? With these intense cross-currents in labor and food costs, how is Darden steering the ship for the rest of fiscal 2026?
Well, they lay out a very aggressive outlook for the full year. They project total sales growth of approximately 9.5%.
That's ambitious.
Very. And to achieve that, they plan to open around 70 new restaurants.
70 new locations. And the capital spending required for this expansion, plus maintaining their existing locations, is projected to be between $750 to $775 million.
It's a massive number.
$750 million in capital expenditure in a single year. I mean, if you've ever wondered why it's so hard to compete with the big guys in the restaurant space, that is your barrier to entry right there.
It is an immense deployment of capital.
Okay.
But as an investor or just a casual observer of business news, you also have to be aware of a very quirky financial detail in their outlook regarding the calendar.
Oh, the 53rd week. I love this detail.
It's a great little accounting quirk.
The presentation explicitly notes that fiscal 2026 has a 53rd week. And for anyone outside the accounting world, retail and hospitality companies often use a specific 52-week calendar system.
Right, to keep quarters even.
Exactly. But eventually, that falls out of sync with the actual 365-day year, resulting in a catch-up year with an extra week every 5 or 6 years.
And Darden is very transparent about the impact of this. That single extra week adds roughly 2% to their total sales growth for the year.
2 whole percent just from existing for an extra week.
Yeah. It also adds approximately 25 cents to their adjusted diluted net EPS, which they project to be between $10.57 and $10.67.
Let's translate diluted net EPS real quick, too.
Okay.
That is their earnings per share, but diluted means they are factoring in all the possible shares that could exist if, say, employees cashed in their stock options or convertible bonds were triggered.
Right. It's the most conservative way to look at their profit per share.
And a whole $0.25 of that profit is purely because the calendar is artificially longer this year.
Which is why you always have to read the footnotes.
Always.
If you're an everyday investor reading a headline that says Darden sales are up nearly 10%, you might get overly excited. You have to realize that 2% of that is essentially just a colander trick. I mean, it's a real week of sales, but it makes year-over-year comparisons slightly skewed.
Definitely. And as they expand, they are also doing some strategic pruning, it looks like. They mentioned the newly acquired Chuy's brand, noting that Chuy's won't be fully included in the same restaurant sales metric until it's been operated by Darden for 16 months.
Which is standard practice. You want to ensure the baseline data reflects Darden's operational impact, not the residual momentum or, the struggles of the previous ownership.
That makes sense. But the more ruthless note was about Bahama Breeze.
Yeah.
They state plainly that Bahama Breeze locations are expected to be closed or converted to other brands by Q4 2027. They are just quietly suffocating the brand.
It's true. And this raises an important question for you, the listener, to consider. What does it actually take to continuously drive a publicly traded restaurant company forward?
A lot of ruthlessness, apparently.
Yes. In an industry where consumer tastes shift rapidly, you cannot afford to be sentimental about a brand. If Bahama Breeze is dragging down the portfolio average, a company like Darden will simply dissolve it.
Right.
They will take that prime real estate and convert it into a LongHorn or an Olive Garden that generates the required return. It is adapt, convert, or close.
It's corporate Darwinism playing out in your local strip mall.
It really is.
So, to pull all of this together, what we are looking at is an incredible high-wire balancing act. Darden is leveraging absolutely massive scale to survive an economic climate that is deeply punishing right now. They are eating the cost of beef and seafood inflation by capitalizing on dairy deflation. They are managing creeping labor costs by relying on predictive data.
Yep.
All while spending nearly $1 billion a year to expand their physical footprint and buy up new brands while ruthlessly cutting the ones that don't perform.
It is a phenomenal display of operational control in a notoriously uncontrollable industry. But, it leaves me with a final thought for you to mull over.
Let's hear it.
We've just spent this time breaking down how a multi-billion-dollar giant like Darden, with all its centralized data, its immense buying power, its ability to hedge commodities, and its sheer scale, is fighting tooth and nail just to maintain a 15 to 23% profit margin amid modern inflation.
Yeah, it's a grind even for them.
Right. So what does that mean for the independent mom-and-pop restaurant down the street from you?
Oh, wow.
They don't have 13% of their spend in deflating dairy to offset their rising beef costs. They don't have predictor algorithms for staffing based on the weather.
No, they definitely don't.
As the big players are forced to get even bigger just to survive the math, will the future of dining out belong entirely to the giants?
That is a fascinating and, frankly, a bit of a chilling thought for anyone who loves their local neighborhood spot. It makes you realize that the romantic, chaotic kitchen we talked about at the very beginning, well, that human art form is currently in a brutal fight against the corporate spreadsheet.
And the spreadsheet has a massive amount of capital behind it.
It really does. Thank you so much for joining us on this deep dive. Keep asking questions about the businesses behind your everyday experiences. And, well, the next time you order the unlimited breadsticks, you'll know exactly how much corporate strategy is baked right into the dough.